Yeah, and what are the risks that you foresee? Because, sometimes living in India, you also feel like, you are feeding into the same echo chambers and everyone is so bullish about the India opportunity at large. The show also called the India opportunity, so a lot of people will also think that, this is a sure shot which is going to happen. But what are the potential risks that you foresee?
Well, Shrishti, one thing I've learned over the last 20 years of investing is that in investing, there's no black or white. Investing is not a deterministic game. It's all about shades of gray. Same thing with India as a country. Nothing is perfect. We have many big risks which lie in the Indian market. For example, geopolitical risk is one of the biggest. Is recently we were on the verge of war with one of our neighbors,
Yeah.
and we got a ceasefire. But if that war had prolonged and become something bigger, then you would have seen a flight of foreign capital from the Indian markets.
Yeah.
And one more big risk in the Indian markets, which global investors often think about, is the political stability risk. Right now, you have a stable political regime at the center. But in the past, when you had coalition governments, that time policy and decision making was very slow,
Yeah.
and reforms used to happen at a snail's pace. If in the future you have again a very fragmented coalition government at the center, that again may lead to valuation derating for India. So political stability risk and geopolitical risk, these are the two big risks that all the global asset allocators consider when they are looking at India.
Yeah, because it's absolutely crucial as an investor to be very mindful of the risks that you underwrite as well, right? You can be very India focused, but you have to keep these risks in mind because they are very real risks as we just lived through one cycle. But, coming back to some of the timeless principles, because my intention with this podcast, especially sitting with you, was to focus on the timeless principles that you've covered in your books and focus on the real value investing wisdom which a lot of the people who've just entered the markets maybe around the pandemic or after haven't really lived through the pain of losing big chunks of money because what we've seen is a joyride so far, right? Like we have had corrections but 30-40% is still not close to something like you would have lived through during the financial crisis. Let's talk about some of the timeless principles that you think you have benefited the most of in terms of value investing.
Well, there are three timeless principles of value investing, and all three of them have been espoused by Ben Graham in his book, The Intelligent Investor. First principle is to look at every stock as part ownership in a business. A stock is not a ticker symbol flashing on the screen or a price which is just going up and down. You're actually buying a stake in an actual business. So, like Warren Buffett has very rightly said, I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor. So you have to take an ownership mindset when you're investing in a publicly listed company. You have to look at the valuations, you have to look at the people behind the business, you have to look at the balance sheet, the working capital, the cash flow, all the basic hygiene factors have to be considered before you make the investment. That's the first principle. The second principle is that of Mr. Market. So, you know, the public markets, contrary to private markets, are highly inefficient some of the time. It's efficient most of the time.
Hmm.
But there's a sea of difference between saying that the market is efficient most of the time and the market is efficient all the time. There are periods or occasions when value gets completely dislocated from price. Price basically does not reflect value in the business. And Mr. Market is a manic depressive. Sometimes he's very joyful, and and the stocks are selling at very expensive valuations. Sometimes Mr. Market is very fearful, and he offers you pieces of ownership in a business at throwaway valuations. So inculcating the patience to patiently wait for the opportunity to present itself is what distinguishes great investors from good investors. Most investors have this urge of doing something all the time,
Yeah.
but this is not a place where where you have to strike at every pitch that is thrown to you. You have to just patiently wait, and just when the right opportunity presents itself, that is when you make a significant allocation. That's the second principle. And third and most important principle is that of margin of safety. When you're buying a piece of a business, do not just buy it at any exorbitant valuation. The price also has to make sense because a great business is not necessarily a great stock. So you have to distinguish, what is embedded in the current stock price of the company versus what the ideal valuation should be. So that is basically how you make use of these principles and come to a sound investment decision.
Yeah, absolutely. Let's talk about, some examples also, because, while people understand these principles or might have theoretical knowledge about it, but how to apply it in your investing world really makes all the difference, right? So we don't have to take specific names if you're not comfortable, or maybe, if it's in hindsight, you can talk about some examples, but would love to learn about some of the opportunities that you personally tapped into at throwaway valuations, which you might have benefited a lot from.
So I'll talk about a past investment which I had made in June 2022, and this was June 2020, and this was a stock named Rajratan Global Wire. Basically, the business, it was so between 2018-19 and the first half of 2020, the Indian auto industry was in a down cycle, and investors' attention on the entire auto sector was very low. So there was this micro cap company called Rajratan Global Wire, which they basically make bead wire for tires. It's a critical input in the tire making process, and the stock was available at a trailing P multiple of 5 times on depressed earnings. So it was not a case of having a low P multiple on cyclically peak earnings. Here you were getting a company at a P multiple of 5 on depressed earnings, and you could buy as much stock as you wanted because investors were not interested in to buy any auto or auto related stock at that particular point of time in 2020. And when the auto cycle recovery eventually took place over the next 2 years, because of earnings growth and valuation re-rating, the stock of Rajratan Global became a 20 bagger for me in just 2 years.
Wow.
So basically, this is a example of applying value investing principles that you are able to buy a good quality business with a decent balance sheet, good operating cash flow, high insider ownership at a throwaway price. So that's basically how you make the and multi-baggers Shrishti, generally take place. The very big multi-baggers generally take place after the bear market, because that is when you get good quality businesses at throwaway valuations. In normal markets, you'll get compounders, but the really big multi-baggers you find only after a bear market.
Yeah, I think, Mr. Sanjoy Bhattacharya, who I hosted on the podcast, he was like, I pray for an event like a financial crisis to happen again, so that I can become like really, really rich, right? So a lot of people don't understand this mindset because they're like, you're an investor in the markets. What will happen to your portfolio if it sees a 70-80% drop? And, do you even have the appetite to be able to live through that kind of a cycle? But what is your mindset now when you're dealing with a bear market? What is your position sizing? How do you think about it? Where do you try to find opportunities? Let's talk about some of the tactical tips that people can actually implement and use.
Sure. So the biggest lessons of investing are often are always from a bear market, and those lessons bear fruits for a lifetime for all investors. So in my second book, The Making of a Value Investor, what a bear market talking about investing, I've talked about some timeless lessons which a bear market gives you. The first big lesson which I got to learn from my seniors and colleagues during those 2 years of 2018-19 in India was that India will continue to grow at a steady clip. Nifty stocks may compound their earnings at 10-12%, but there will be a handful of small cap and mid cap stocks which will grow their earnings per share at 25 to 30% for the next 3 to 5 years. They're bound to create wealth for you in the long run. So, what you need to do is you need to have the conviction to back them and then simply wait for the cycle to turn, because just like bear markets are not forever, bull markets are not forever, and these things often just take place in cycles. What you need to do is buy into these high growth companies during a down cycle and then patiently wait for the sentiment to improve. That's basically how you make the big money. The second big learning which I got from my colleagues and seniors in that bear market was sanity will eventually prevail, like it always does after every bear market. In the middle of a bear market or a market crash, when all hope is lost and it seems that nothing will improve ever, that is when you need to look at stock market history and understand that over the last 40 years in India, every fall in hindsight has been a buying opportunity.
Yeah.
So that is the big picture thought which you have to keep in mind. You have to have conviction and belief in India's entrepreneurs, India's business ecosystem. You look at all the big investors of Dalal Street. All of them have got this one single thing in common. They all believe in India as a
Yeah.
country. That whatever happens, India will do well. That is what helps them stay the course through all the ups and downs in the market. That is the thinking we need to inculcate as investors. That's the and basically in bear markets, like we were asking about allocations, because you're able to get good quality business at throwaway prices, at very cheap valuations in a bear market, your portfolio becomes more concentrated with concentrated bets of probably 10-15 stocks only, where you can have 8 to 10% allocations in individual stocks. Because in my second book, I've talked about this that Investors talk about stocks and buying decisions. Rarely does anyone talk about allocation. But
Yeah.
the great investors, if you see, it was their sizable allocation to their big winners, which made them really rich.
Yeah.
So you do have to. This is something which you get to learn with and appreciate with the passage of time. After your portfolio reaches a certain size, that allocation is what really got me here.
Yes, absolutely. In fact, even Mr. Ramesh Damani, who I had the privilege of hosting, spoke about exactly this, that, he identified a lot of companies right very early on. But the reason he regrets sometimes not taking the big, bold bets or backing up the truck, as he calls it, is because his position sizing was off. And now he's trying to change that, in his life and investing wisdom.